Hi, my name is Kim Watson. In this video I'm going to show you a very simple strategy which is based on Heiken Ashi. Now what I suggest is a few things. Firstly, that you write down the rules as you go along, ideally. Secondly, you test it. Third, if you like the video, give me a thumbs up please, and subscribe to my video channels for other content such as this. There is one fourth thing which is available. Generally people they'll give strategies away and not give you any help, support or anything with it. If you would like some free support, free help, free questions answered, I do have a public Telegram channel that you can use. If you follow the link on underneath the video, there'll be a link available. If you click on that, I will send you just pop your email address in, I will send you an invitation to that Telegram channel, and you can then ask further questions. Just make things really simple, or you can ask questions off of YouTube straight on the comment section below. One thing I do ask is, ideally, if you like this sort of video, give me a thumbs up and also subscribe to my channel. Right, let's get into the nitty-gritty. First things first then is the strategy itself. I've talked about write the rules down. Did I mention about testing it? Test it. Test it on what you're using. I often get, well, what can it be used on? Well, it can be used on anything. It's whether or not it works on anything, and the important thing here is testing it. I find that it works with some currencies and so much better than others. Others it will not work on at all because they spend most of their time consolidating, or the correlation between the currency pairs are too close, so the setups are rare and not necessarily the best. Other currency pairs, they work in good cycles and you've got some good opportunity to use. Now, the background about the strategy is a trend-based strategy, and it's an important factor. I'm not looking to get the absolute top, to sell the tops or buy the bottoms. The strategy is not based on that, it's based on trend. So that's what I'm looking for. I'm looking for some trend, ideally in the first place, or something that's highlighting some trend, and then I'm trading within that trend, in the direction of the trend. I'm not looking to use it as a counter trend. You can see sometimes some of the best, it seems, signals often come right at the top or right at the bottom. However, there's probably a dozen signals when you look back clearly at the top and the bottom which failed before you get to that good one. So what I'm trying to do is keep the probability a little bit on my side and trade it in direction of trend. So it's trend following. Time frame wise, there's two elements of this. There's, well, what time frame do I trade it on, like dailies, 4 hours, 60 minutes, 5 minutes? Well, the answer to that is yes. You can trade it on all of those time frames. It's really up to you. The standard principles will work, as the market being fractal, it will work across any of those time frames. It is possible to use the lower time frames to get into the trade which is looking like it's setting up on the higher time frames. So for an example, I've just put this flag on here because we're going to be looking at this particular example. It's on the US dollar yen. It's actually set up on the shorter time frames and the longer time frames. It's all set up, but the longer time frame took longer to set up. It had already kicked off on the shorter time frames. Can you trade or take the trigger off the lower time frames and then trade it onto the long? Yes, but it depends on what you're trying to achieve. Sometimes you're just better off with trading within a specific time frame, but it's very low maintenance. Where whatever time frame you're trading it on, you can use some alerts. It's an occasional view to check how it's doing and move stops, and that is basically all you're doing. It's maintenance basically. So the lower the time frame, perhaps the more frequent the maintenance. In terms of lower time frames, when it comes to intraday trading, I recommend that if you're using such as currencies, you trade between specific times. Now, when I made my notes here, I've put 8 a.m. till 9 p.m. That includes the sort of the London European markets through to the US close. Now, it might be that when you're doing your testing and just checking it out on what you trade, or what you're trading is more volatile at different parts of the day. And if you're trading on the Nifty 50 or the Nikkei, well, you may trade it through the Asian session, of course. So, in which case you're going to get more accuracy in the time when the most liquidity comes through. So I'll leave that to you. But if it's Forex, I would generally say 8 a.m. London time through to 9 p.m. latest. Already mentioned it can be used anything. Let's get cracking on what it is. And as I said, it's based on trend. Within the trend, we're looking for some consolidation to give us an opportunity to get in. You're going to be drawing some very simple little trend lines, short-term trend lines near the consolidation, and then using very simple tools to manage the trade. So we'll be looking at a moving average, simple moving average. So you'll need a chart with the 34 I've used. It's a Fibonacci number. We won't go into detail about it, but it's a nice somewhere in between the 50 and the 21. You could use the 50. 21 would be too close, but the 50 could be an alternative if you're don't want to use the 34, but I strongly recommend the 34 is a lot better because you'll get better results. Anyway, so 34 simple moving average. You will need to be on your chart somewhere have the average true range. It just so you can see, it just makes life a lot quicker when we're looking to set up stops. So you'll need the average true range. Obviously, you'll need to be able to put the Heiken Ashi candles on, and one other thing you'll need is, and it's available on just about every bit of software out there, I believe, but you'll need Donchian channels, DC, as I'd prefer to call them, Donchian channels, available to you as well. But I'm using TradingView here. It's all on TradingView, and it's very, very simple. I believe it's on most other charting packages as well. They're not sort of difficult things to find. So that's what you need. What we're looking for then is what I look for in my planning sessions in the morning. I'm looking for opportunities, of course, and this is just a tool that helps with those opportunities. In this particular case, when we looked at this on Wednesday, we had this sort of upward movement, this little flag effectively. There was previously, look, a pennant sitting at the very highs here. I say the very highs were up here, of course, but near the highs. And there could have been an opportunity earlier on, this is a daily chart, to get into a trade back then. But what I'm going to show you is one, I didn't actually trade it, which was really annoying because I had I'd pointed out in the morning. I do a morning planning session. We look at through all the markets. I identify the best opportunities, and then we get cracking with whatever we do during the daytime. So that's done in the mornings. In that little planning session, we went through this. The problem is another setup occurred exactly the same time, and I was looking at it was the euro, and I ended up trading the euro and putting the trade on the euro. And meanwhile, I come back to this and it had already got. By the time I got back to it, I hadn't realised they'd both gone off. Anyway, I missed it. So there we go. So it's not one. Here's I made £1 million on. It was just a miss, but it's a lovely setup, and it lets me demonstrate what it looks like. I will try and show you some ugly stuff as well, but mostly there's not a lot of ugly stuff around it, because if it looks ugly, we don't trade it. Simple as that. So the plan: consolidation in what is a trend. If I was trading this off the daily, well, it would need to be below the 34, which it is. But I'm going to take it down a couple of time frames, because I was actually looking at intraday, and I was looking at 4-hourly, and specifically that I actually was looking at the 4-hourly picture, and this is that same currency pairing. You see a nice strong down. We'd had the retracement, and at the time when I was looking at it, it was just doing it. It had just broken its trend line a little bit, and I was looking at that. I was thinking, well, it looks nice, and then I drew and this is the very line, I drew the trend line across the lows here. So I just drew a line across the lows there because it's pulling down. It's done a little flaggy sort of thing there, some consolidation. I'm just waiting then. I was waiting for some early-ish breakdown. I thought, well, it will come at sort of 8 or 9 o'clock. Well, it didn't. So all you need to do is put an alert. The next phase of it is checking, obviously it's below the 34. Well, the important thing when I say below the 34, it's got to be the setup bar has got to be below the 34. Sometimes the 34 may be quite close to it, but ideally it will be below the 34 anyway. But it's the close of the setup bar must be below the 34 for a short, or must be above the 34 for a long. So if you want to write that down, pause this right this moment and write it down. I'll repeat it. The setup bar must be below the 34 simple moving average on the time frame you're trading it for a short. For a long, it needs to be above the 34 simple moving average. So we're trading then in trend. Okay. I'm now going to talk about the trigger, or the setup bar I should say, and then we'll talk about the trigger. The setup bar itself in this particular case is this red bar here. What it's done, what we've seen is the price action moving up in consolidation, and then it's broken through my trend line. I'm not looking to take the trade off that particular bar. It comes the next bar, but I am looking for where this closes. It's closed below my trend line, so that's first step. It's closed below my trend line, and of course it's closed below the 34. So that is a setup bar. From that point, if it's not moving so quickly, and it's probably not moving so quickly because you can see the price had moved back up here, I can measure, and I've got time to work out how much risk, where I need to put the stop. Now you've got some options here. My method is very, very simple. I don't necessarily need to put a stop right up the highs here. I've always worked on an average true range, or the size of the bar that's setting up. So either the whole of this bar or the average true range. The average true range in this particular case, we'll just take this example. Let's just double click on here. The average true range at the time of that bar there was set up, was sitting at 27 pips. Roughly 27 pips. So it was sitting at 27 pips. 27 pips on a market like this was probably too small anyway. And if it was halfway up this particular bar, the setup bar, I wouldn't use it. I'd use the setup bar itself. So it's either the average true range or the setup bar, above the setup bar, whichever is highest. If you want to, of course you can place it at the highs. It really doesn't matter, it's up to you. So that is the setup bar, and we know our risk. The stop then, I've already discussed, is either the above the high or the average true range, whichever is the highest, away from the entry. So the stop is up here. The entry, on top of that, I should say the entry for day trading, you need a minimum of 2 pips below the trigger. So we're talking the triggers now. The trigger would be 2 pips below the low of the setup bar for a short, and 2 pips plus the spread of your broker above the long side. So it's just giving us a little bit of a chance if the price just comes down and gives us the double bottom or double top and then moves off, we've got the opportunity of not being in it. So the price action's got to move. So the next point, as I said, that gives us a stop, it gives us a trigger. So we got to that part of the strategy. We got the setup, stop and trigger. The next stage, we don't need this average true range showing. The next stage is the exits. Now a lot of the time, I'm going to just drag this across here, a lot of the time we will look at previous highs and lows. I do it myself. A lot of the time you're looking for where the potential exits would go, which is fine. But what I did on this strategy, because it's a momentum based strategy, I want to try and get as much out of it as possible. So this is, and the principles of the the Heiken Ashi bars is that we're using them to stay in a trade. So we want to stay in the trade. We're going to use we're going to let the trade take us out, and so we're going to use effectively a trailing stop. So the trailing stop will be based in a specific way. So firstly, we've got our initial stop, we've got an entry. We're then going to be looking at well, we're not going to know the target. We're going to use a trailing stop, because any of these other levels, yes, they could provide support or resistance, vice versa, on longs or whatever else. We don't know it's going to stop there. We don't know how it's going to move. This particular one, of course, it moved off really quickly because I wasn't in it, and it ran down nicely, and it triggered and ran. So it happens when you're not in it, of course. What you're going to do is use a tool for once we're in it to keep us in it. Now, I've already mentioned you need the Donchian, that's DONCHAIN bars channel on your system. Now it looks quite messy, hence why I don't have it on all of the time. I take it back off again, and when you have it on, when you've got it, you need to adjust the settings. So this is important, very important. I've got the symbol and not the, let's get the settings for the Donjin channel. There we go. Firstly, my trading, the length I've got it on is, it comes in, and it will be a standard 20 period. So it will look like this on standard charts, all standing packages. I want it really tight. I just want a 2 period. You can use 3 period and whatever else, but you've got to test them. I'll leave it up to you. 2 gives it enough for what I need it to do. You can see it's quite closely wrapped to the price action. The other thing on here with Trading View is got the average down the middle of it. I don't want that, so I'll just take that out. So I've got a little bit less on my chart at least. The idea is to keep the chart as clean as possible, or clear as possible. Okay, so there we are. We've got, for our longs, we've got a point, sorry, our shorts, beg your pardon, a point of a trailing stop. It is literally the upper channel. So as every candle, so again here we've got the entries and everything else, but as every candle finishes and closes, we then just maintain. This is the maintenance bit. So initially we're using an average true range, or the size of the candle, whichever's the biggest. Once it comes into the very first bar's closed, after it's triggered, when that's closed, we can look and see where the on that point, which is right the way up there, it's not even worth moving it often on the very first one. It's barely moved, and you'll find it's only the second hour or the second day that you're actually coming to actually doing any movement. And then we've got the second bar in, so we can go back, we can set a timer or whatever we want just to look at it. Doesn't need to be on the hour, it can be any time within the first, well, I'd give it, I wouldn't leave it too long if you're intraday trading, but it can be within the first 10-15 minutes, probably even half an hour. If it's moving as quick as this, it could have been the next 5 hours. But anyway, seriously, the point is that you actually move the stop down to where my pointer's pointing at this stage here, which is the upper channel point. So that the channel, that's where it's moved to. So the stop is just trailing slowly and behind. As the third bar came in on this particular occasion, then the stop is moved down to this point here at 140.78. So we're at this stage 3 bars in, and we're beyond break even, which is okay. It's not a race to get into break even, by the way. It's just the idea is to try and get as much out of the movement. Next bar comes in, the channel has moved down, so it's an adjustment to 140.34. Next bar comes in, the channel's moved down, so it's 140.07. Next comes in, it's closed down there, 139.98. Now this might look like, well, okay, I'll get stopped on it. Well, you're waiting for this bar to close, so you won't get stopped on it. It's only if you've moved it too early and you start seeing it forming there. You've got to wait until the bar's closed. So you put it in. The next bar comes in. It's continued in the journey it was taking, and the stop basically stays at the same place. Next bar, well, then we're trailing it down. It's consolidating, so you will get quite close at times. 139.69. Next bar, it's fallen asleep and you've fallen asleep, so you're probably not adjusting all these because if you're trading it intraday. I don't suggest you stay up. As it's moved through though, through the Asian session there, it's just moved quite nicely. 3 o'clock, 4 o'clock, 5 o'clock. It really is the ideal. If it's 6 or 7 or 8 when you've come out, well, in this particular case, it's fine. You might have not moved it down far enough, as in it could have been tighter. You might have still been on your 10 o'clock or whatever bar back here, and you might have still been in the trade, which would have been fine because it's moved on in this particular case. But ideally, you'll just track it down there. Obviously, not sitting up there through the Asian session. That's why I quite like it on the 4 hourlies. But intraday wise, some people would just say, it's already, in this particular example, it's done a great amount of distance. However, you want to trade it as much as or trail it as much and as far as you possibly can, because the idea is that you're going to get the best result out of the trade. But there is logic to going to bed, and I'd suggest you do that at night times and not sit and watch it. So, as I say, if you set it on the 10 o'clock bar, it'd been right away up here somewhere. So the stop would have been, that's where the stop would have been at that time. In this particular case, it was fine. Other cases, it might just get tracked out. However, even down here somewhere, you've got a tidy profit between the two levels. So in this particular case, again, and in terms of entering the trade in the first place, as I said, the important thing is to be in the volatile area. If you're taking the trade at 9 or 10 o'clock at night, then you haven't got much time to do maintenance, and you just got to hope then it's going to be moving through. Now, if this was a daily chart, well, that's fine. You just come back each day. At some point during the day, the next day after it's moved down, just come back, have a look where it is, and move the stop. Same with the 4 hourlies. You're not going to be maintaining it every single 4 hourly. The daily is the easiest one because it doesn't matter which time of the day you come in there. Okay, that's pretty much the strategy. Let's run over this again then, the rules of engagement, etc. First rule of engagement, ideally you're in a higher time frame trend. It doesn't necessarily have to be the case, but you must be in the trend of where the market's moving at the time. In other words, for shorts, it's got to be below the 34. So this is my rough bullish bearish signal effectively. So for the shorts, it must be below the 34. If it was for longs, it would be above the 34. Next comes looking for the setup candle and the setup pattern. The setup pattern must occur. If you haven't got a setup pattern, you're not going to be trading anything because it needs some sort of flag. It could be a triangle if it's at the right time. I like the setup on intraday basis to be later in the morning, 8 o'clock, 9 o'clock. I mean, if it comes in at 1 o'clock, wonderful. So I like this. This to me was absolutely perfect. Draw your trend, wait for the bar to set the alert on the bar if you like, and you'll know when it's being closed. You've got time when it's closed to go back and have a look. Then set up your risk. Your risk is going to be 2 pips below, including 2 pips below a short or 2 pips plus the spread for a long. Your actual overall stop measure for the short then also is either the average true range or the high of the setup bar, whichever's the most. And then that is it. Trigger wise, 2 pips. You can put a sell stop in there, 2 pips below the low there. Put the sell stop on, put the stop loss on, and leave it. If it doesn't trigger in the next bar, you might say, well, it hasn't got momentum and I won't take this. I always took that attitude. So if it didn't set up in the next day or next 4 hours, I'm not interested. Momentum's gone. I want it to work. Then that is it. Then you're trailing, as I say, then you're in maintenance mode. You use the Donchian channels, period of 2, and just literally move the stop, not to the top of the bars, by the way. Just use it. It'll give it more chance of actually staying in by placing it on the Donchian bars channels, on the top of the Donchian channel. Eventually you'll get stopped out, and hopefully you'll get stopped out with a tasty profit target. Now, of course, as I said, you can use other methods. You can decide to come out on any other method you like, but this is just a case of using a trailing stop in trending markets, and it's ideal for trending markets. Setting up at the moment, if we was looking at this is on a Friday night, so it's not going to be setting up for me because it's particularly on an hourly. I'm not interested in this on this time frame. It is though set on a normal time frame. We could draw the trend line across there, wait until we get the green one. We've got a higher low, it's above the 34. We could be trading that. We don't have to look at the bigger time frames. Personally, my preference when I'm trading it is to think, well, actually I prefer the short side than the long side, because the short side has the big time frames with it and it's all looking good. So instead I would look at this on Monday. I will be looking at this on Monday. Now I've noticed it. I'll be looking at the sort of flag going across here for now, somewhere about there. I'll put an alert on that. On Monday I'll look at it. If the alert goes off on Monday at some stage, I won't put the alert until Monday on it, but at some point during Monday, if it breaks down, I'm just waiting for the setup bar, which is a close below the trend, and that will give me the point to calculate my stop, my risk of the position, and set a sell stop in this particular case if I was looking on the short side. So there we go. That is it. I can't give you anything more now at this stage. I think I've given you enough. It's 27 minutes long. This is long enough for anything and anyone's concentration. You might need to watch it a second time to make notes if you haven't the first. As I said, use my Telegram if you want to join my Telegram. You're willing to do so. I'll put the link on below the YouTube video. That's it for now. Take care. Bye for now.